Have you ever truly considered the nature of money? Not just the coins in your pocket or the bills in your wallet, but the very essence of what it represents. We often think of it as a tangible store of value, a reward for our labor, something solid and real. We see ancient gold coins, weathered banknotes, and imagine a direct line to the digital numbers that flash on our screens when we check our bank balance. But what if the vast majority of money in existence isn't physical at all? What if it's something far more abstract, created in a way that remains largely invisible to the public? Understanding this system is not just an academic exercise. It's fundamental to navigating the world we live in. This is the hidden story of how money is made. The process begins not in a government mint, but within the private banking system. When you approach a bank for a loan, be it for a house, a car, or a business, you might assume the bank is lending you money that other people have deposited. This is only a tiny part of the truth. In reality, when a bank approves your loan, it doesn't pull from its vaults. Instead, it creates new money digitally with a few keystrokes. This new money is entered into your account as a deposit and simultaneously recorded on the bank's ledger as a loan, an asset to them and a debt to you. This is the core of fractional reserve banking. Banks are required to hold only a small fraction of their deposits in reserve, allowing them to create and lend out a much larger amount. In an instant, the money supply expands. It is, for all intents and purposes, created out of thin air, born from a promise to pay it back. This mechanism of money creation has profound implications for the entire economy. Because virtually all money is created as interest-bearing debt, more money must always be created to pay back the principal plus the interest. This necessity builds a requirement for perpetual growth directly into the financial system. If the creation of new loans and new debt slows down, there isn't enough money in circulation to service the existing debts, leading to defaults, foreclosures, and economic contraction. This dynamic is the engine behind the recurring economic cycles we experience. The periods of rapid expansion, or booms, fueled by easy credit and increasing debt, followed by inevitable contractions, or busts, when the debt burden becomes unsustainable and the system corrects itself. The stability of our entire financial world is balanced on this continuous cycle of debt expansion. So the next time you see the numbers in your bank account, remember that they are part of a much larger, more complex story. It is a story of debt and digital creation, of expansion and contraction. This isn't just a system for the economists and bankers to understand. It is the invisible architecture that shapes our opportunities, our financial security, and the very fabric of our society. By peeling back the curtain on how money is truly created, we empower ourselves. We gain the critical financial literacy needed to ask important questions. Is this system sustainable? Is it fair? And as we move further into a digital age, what will the future of money look like? Grasping the hidden mechanics of money is the first step toward not just understanding our world, but actively participating in the conversation about how to shape its future.